studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that Sunky died.
Welcome to the real world of tax practice. Up until now, you may have learned tax concepts using clean examples, perfect scenarios, and simple salary versus dividend decisions. But real clients are rarely that straightforward. In practice, owner-managers often have incomplete records, mixed personal and business transactions, and situations that don't fit neatly into textbook examples. That's why preparing taxes is much more than entering numbers into software. Your role is to analyze information, identify issues, and solve real-life financial puzzles. Throughout this topic, you'll learn how to recognize common shareholder loan problems, understand unexpected tax consequences, deal with payroll and employment insurance issues, identify legitimate business expense claims such as vehicle and home office expenses, handle difficult client conversations, and avoid common mistakes that can lead to costly tax problems. The key message to remember is that tax planning is a holistic process. Every transaction affects something else, whether it's the shareholder loan account, deductible expenses, payroll, employee benefits, employment insurance, or the final tax calculation. Looking at only one piece of the puzzle can easily lead to incorrect conclusions. As a tax preparer, your objective is not simply to calculate tax. Your real value comes from understanding the complete financial picture, asking the right questions, organizing messy information, and helping clients arrive at the most accurate and tax-efficient outcome possible. Keep this mindset throughout the rest of this lesson, because everything that follows builds upon these real-world situations and practical problem-solving skills. The shareholder loan account is one of the most important concepts every tax preparer must understand, because it is also one of the most common sources of tax problems for owner-managed corporations. When an owner takes money out of the corporation without treating it as salary or a dividend, the amount is usually recorded in the shareholder loan account. Many business owners casually withdraw funds, don't keep proper records, and assume that because they own the company, the money is automatically theirs. However, from both a legal and tax perspective, the corporation and its shareholder are separate entities. The biggest risk arises when these shareholder loans are not cleared properly. If the balance remains outstanding and doesn't meet the requirements of the Income Tax Act, the Canada Revenue Agency may include the entire amount in the shareholder's personal income. This can result in a much larger tax bill than the owner expected. For example, imagine an owner withdraws $100,000 from the corporation during the year. If that amount is simply recorded as a shareholder loan and no further action is taken, the full $100,000 could eventually become taxable to the shareholder. Fortunately, there are several legitimate ways to reduce or eliminate the shareholder loan balance. One option is to pay the owner a salary, which creates payroll deductions, CPP contributions, and additional RRSP contribution room. Another option is to declare dividends, allowing the shareholder loan to be cleared through dividend income. A third option is to reimburse legitimate business expenses that the owner personally paid, such as eligible vehicle or home office expenses, provided proper documentation is available. In practice, experienced tax professionals rarely rely on just one method. Instead, they usually combine salary, dividends, and legitimate expense reimbursements to achieve the most tax-efficient result while maintaining compliance with CRA requirements. The key takeaway is simple. Never ignore the shareholder loan account. It tells the real story of how much money an owner has taken from the corporation and managing it properly is one of the most important parts of effective owner-manager tax planning. Now that we understand the shareholder loan account, let's look at the other key tax planning issues that every owner-manager and tax preparer should understand. First, consider business expenses. Many owner-managers use their personal vehicle or work from home, creating opportunities to claim legitimate business deductions. However, only the business portion of these expenses is deductible. Proper documentation, such as mileage logs, receipts, and supporting records, is essential because these claims are frequently reviewed during CRA audits. Next is the salary versus dividend decision. Many beginners assume that dividends are always the better option because they may reduce payroll costs. In reality, there is no universal answer. Paying a salary creates CPP contributions, generates RRSP contribution room, and provides employment income. Dividends may offer different tax advantages, but do not provide those same benefits. In many situations, the most effective strategy is a carefully planned combination of both salary and dividends. Another important consideration is employment insurance, or EI. Owner-managers who control their corporation are often exempt from EI premiums. However, this is not a rule that applies in every case. Factors such as ownership percentage, family relationships, and the employment structure must all be analyzed before deciding whether EI applies. Never assume an exemption without reviewing the facts. Corporations can also provide valuable employee benefits, including health benefits, insurance premiums, non-cash gifts, and certain allowances. These benefits can improve tax efficiency when structured correctly. At the same time, some benefits become taxable to the employee and must be reported properly, making careful planning essential. Technical knowledge alone is not enough to be an excellent tax professional. One of your most important skills is communicating with clients. Sometimes you must explain that they owe more tax than they expected because of poor record keeping, inadequate planning, or misunderstandings about shareholder withdrawals. By presenting the facts clearly, educating the client, and discussing future planning opportunities, you help build trust while reducing future tax problems. Finally, remember the common mistakes that lead to unnecessary tax issues. Ignoring shareholder loans, relying too heavily on dividends, maintaining poor documentation, and making quick tax decisions without proper planning can all result in higher taxes, missed opportunities, and increased audit risk. The most important lesson from this section is simple. Every dollar taken from a corporation eventually has tax consequences. Effective tax planning is not about avoiding tax, it is about deciding the most efficient way and the best time for those amounts to be recognized, while remaining fully compliant with CRA rules.